Let's be honest for a moment. Most high-income professionals are being sold a tax story that sounds great, but doesn't match reality. You're told, just start an LLC, create some passive income, buy a business and write everything off. But here's the truth most people won't say out loud. Only 5% of Americans ever live on passive income, and at most, high earners are not trying to build an empire. They're just simply trying to stop overpaying in taxes. So today, I want to walk you through, one, why high W-2 earners pay so much in taxes, what doesn't actually fix your problem, and what realistic tax reduction looks like if you're not trying to be a full-time business owner. Look, listen, this is no loophole myth, just how the tax code actually works. So here's the real problem, why high earners feel stuck. So most of your income comes from W-2. And here's the uncomfortable truth. You are earning income in the least tax advantage way possible. The tax code rewards risk, capital, ownership, and long-term behavior. It penalizes predictable wages, high salaries, and convenient income. So if you're making 300, 400, 500K plus, mostly from W-2 wages, high taxes are not a mistake, it's the default outcome. And that's important to understand because there's no trick into really lowering your taxes. So let's clear out the noise. Number one, just start an LLC. An LLC by itself is not a tax strategy. If you're still earning the same income, doing the same work, and not changing how money flows, your taxes don't magically go down. In most cases, people actually pay more once self-employment tax enters the picture. Two, turn everything into an S corp. Can this help in some cases? Yes, but for high W-2 earners who already exceed Social Security wage limits, the savings are often far smaller than advertised. We're talking incremental improvements, not transformation, okay? Number three, passive income will fix it. This is the most oversold idea in tax planning. Passive income still gets taxed, often triggered by net investment income tax, rarely shelters income unless paired with scaled leverage or time. Passive income is a long-term wealth strategy, not a short-term fix my taxes by the end of the year, okay? So what actually works without having to build a business, right? This is where realistic planning begins. One, retirement strategies. Most high earners underuse. Many high earners max out their 401k and then you just stop there. But if you have any consulting side income or professional income, there are often additional ways to shelter the income that you've already earned without growing a business or hiring employees. Look, this is boring planning, but boring planning saves real money, okay? Number two, expense strategy isn't about write-offs. It's about accuracy. Most high earners are conservative to a fault. They underclaim legitimate deductions such as home office usage, technology, professional education, vehicle strategies. Not because they're doing anything wrong, but because no one ever showed them how to actually document reality properly. This isn't aggressive, it's precise. Okay? Number three, giving without a tax strategy is so expensive. Charitable giving is generous, but often tax inefficient. Cash donations alone rarely move the needle at higher income levels. Structuring how you give can reduce taxes without giving more money. Same generosity, just better math. Okay? Number four, timing matters more than people realize. At higher income levels, when income hits, it matters almost as much as how much when it hits. Stacking income in 1 year can trigger surtaxes, phase outs, higher marginal tax rates. Coordinating timing doesn't require new income, just intentional planning. The honest truth most advisors won't say. If you earn primarily W-2 income, don't want to build or scale a business, don't want to invest capital aggressively, and want maximum convenience, then here's the honest answer, okay? Your taxes will always be relatively high, not because you're failing, but because the tax code does not reward simplicity. Tax savings are earned through structure, long-term behavior, coordination, and long-term planning, okay? There's no shortcuts. So the real question isn't, how do I eliminate taxes? It's, how much complexity am I willing to accept in exchange for tax savings? There's no judgment in that answer. It's only clarity. And clarity is where good tax planning actually begins.